Okay, welcome back. So, on the 2009 rather, production and cash budgeting, or cash and production budgeting, part C here. Prepare a cash budget for the 4 months, January to April 2010. So, to save time, I've just ruled it out like a cash budget should be. The 4 months, January, February, March, April. I've put in the headings on the side here, but we'll see where they come from as we go through it. We start with the receipts, money coming in, and then we subtract the payments, the money going out. Okay, so the first thing from the receipts is sales. Well, they're all sales. This is cash sales. This stands for credit sales 1 month, credit sales 2 months. So if we look at what the conditions are for the sales here in the first part of the question, it says cash customers. 30% of sales revenue will be for immediate cash. So if our sales revenue is 240,000 here, 30% of that will be cash sales. So for January, our cash sales are going to be 240,000 multiplied by 0.3 for 30%, and our amount is 72,000. So 72,000 is your cash sales for January. Same goes then for February. We take this figure of 255,000 and multiply it by 0.3 to get 30%. Same for March, April, May. I'm going to pause now and fill in the figures. Okay, so this is what it looks like when we fill in the figures for the cash sales. Next we move on to, back to our question again here. It says credit customers. So this is the credit sales. 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale, so 1 month after the sale happens, and the remainder in the second month after sale, 2 months after the sale happens. So if we take January sales of 240 here again, and this time if we get 70% of them, so 70% of 240, so it's 240 multiplied by 0.7, which gives me 168,000. So 168,000 is the total amount of the credit sales, but according to this here, it says these debtors will pay their bills 50% or half of that bill 1 month later, and the other half 2 months later. So next thing we might want to do is to get half of 168,000. So multiply by 0.5 for 50% or divided by 2 for to get a half. Either way will work. That's 84,000. So what we're saying is 1 month after those January sales, which is in February, the debtors will pay the 84,000 or half of their bill. Okay, so in the 1 month line, in February's column, we'll put in 84,000 because that's 1 month after January. The other half, the other 84,000, is going to be paid 2 months after those January sales are done. So 2 months after January is March, and we enter it in the March column, and in the 2 months line, that other 84,000 that will be paid. So in total, this, and this, if we added the 3 of these figures together, they should give us the total 240,000 of the sales from January. Okay, so same for February. Next we're going to take this 255,000 and we're going to get 70% of it. 255 multiplied by 0.7 to get 70%, and that is 178,500. And then we'll divide it by 2 to get half of it. That's 89,250. So half of that, the 89,250, is going to be paid in March, 1 month after February. So it goes in the 1 month line, 89,250. And the other half is going to be paid 2 months after February, which is April. So February is here, 2 months later, and it must go into the 2 month line, 89,250. Okay, finally then, or for the next one we go on to, which will be the last one, March, we sell 300,000 worth of stock. So 300,000. We multiply by 0.7 again to get 70%. That's 210,000. Then we half that, 105,000. And 105,000 then is going to be the amount that's paid for 1 month after April. And it goes in here. And that's where we stop because we don't have a May column, so we don't need to put the second figure in here. And that's it. That's done. So what we do then is we total up each of these columns to get the total amount of cash that we're going to bring in for each of those months. This is going to be 72,000. And I'll pause to add up the rest of them. So we're just going to add these two together, add those three together, add those three together. Okay, so that's it. Those are your totals. Next thing we're going to do is move on to the payments, the money going out during the month. So the first item I have in there is purchases. And so as we go down through here, we'll see this was for the sales. This relates back to our materials purchase budget we did a moment ago. These also. The first item, I suppose, really that's telling us anything about purchases here is the number 5, 1 month's credit is received from suppliers. That means if we purchase something in January, we won't have to pay for it until February. We'll have 1 month's, or they will have 1 month's credit. So anything purchased in January is paid for in February, anything in February is paid for in March, etc. So where do we get our purchase information? Well, we get that from our purchase budget that we completed earlier. So in the last part, we completed this materials purchases budget, which said that we'd be buying this much worth of stock in January, that much in February, this much in March, that much in April. So 84,240 is what we're purchasing in January, but because of the 1 month credit, we won't pay for it until February. So we're going to put it into our February column, 84,240. So nothing there, and 84,240 is how much we're going to be paying for our purchases in February. Then our actual February purchases of 57,120, we're going to pay for that in March. So it'll go into March in our cash budget, 57,120. Finally then, our March purchases were 64,020, but we're not going to pay for them until April. 64,020. So that's your purchases done. Next, your wages. Well, basically everything else, all of your payments are down here, so we just run through them as we go through the question. So our wages, 20,000 each month, payable as incurred. So no period of credit or anything like that. We pay it immediately. 20,000 per month. 20,000, 20,000. 20,000. Next is your variable overheads. It says €5 per unit payable as incurred. So this is where it differs a little bit from the cash budgets that we've done previously. In previous cash budgets, we multiplied this €5 per unit by the number of units sold. But what we really should have been doing if we had enough information is multiplying by the number of units produced. But since we didn't have a production budget in those other cash budget questions we had to just multiply this figure by the number of units sold. But in this case, we do have a production budget. We do know how much is going to be produced each month, how many units are going to be produced each month. So we can multiply this figure by the €5 per unit to get our variable overheads. So it's 13,100 multiplied by 5, which gives me, so it's this figure here first of all, multiplied by 5, which gives me 65,500. Then I'm going to multiply each of these figures by 5 also to get my variable overheads. I'm going to pause now and fill that information in. So that's those figures filled in there. Now I'm going to end this video here because it'll be quite long, and I'll continue in the next video and do the fixed overheads, equipment, etc.